I'm honored to be with you this morning talking about my family's business, Evergreen journey. The company was started in 1886, and we're going to be fortunate enough to celebrate our 140th anniversary in August of 2026. The title of my talk today is Building from Crumbs, and the company wasn't started as our family's business. It was actually started as the Isaac Carter Milling Company. It was started by a banking family, and my great-great-grandfather, Alphonse Mennel, was the first employee. The family got control of the company in 1917 and then changed the name of the company to the Mennel Milling Company as it's known today. Looking at the two founders of the business, Michael Harder came from a wealthy banking family, was an entrepreneur, chose Fostoria, Ohio as a good location to build a flour mill, and they built the largest flour mill in the country not located on water. They spent $200,000 and built a state-of-the-art flour mill. He hired Alphonse. They knew each other. They were both farm implement dealers in Northwest Ohio. Alphonse took a salary of $1,600 a year, bought in 100 shares in the company, and had a 4% profit share. Michael then moved on to Congress and joined Congress in 1891, 5 years after the business was started, served 2 terms there, and then ended up ending his life shortly after his service in Congress. So really from day one, Alphonse was the one that was the leader of the company and in charge of the operations of the business. The second generation of the company was led by Louis Mennel on the left and Mark Mennel on the right, and they inherited a very successful business. Alphonse had remained connected to the old country and exported a lot of flour to Europe, and these two gentlemen came into a very successful business. And if you look at the years they were involved in the business, it was through the duration of World War I, the Great Depression, and World War II. And we kind of look at that as a price control era. It was a great era in our company's history, or the country's history, to own a flour mill, because the national government was buying most of the flour coming out of the mill during World War II and exporting it as food aid to Europe. And then during the Great Depression, Mark actually sat on Hoover's Food Aid Council, and they supplied flour to the country to feed those that were in need. And then during World War II, the Red Cross was our largest customer, buying flour and shipping it to Europe to feed the troops. Unfortunately, because they inherited such a successful business, they didn't spend a lot of time reinvesting or changing the direction of the business. We look back at the minutes from the shareholder meeting during that era, and really what they talked about most of the time is what kind of dividends could they take out of the company. The family lived very well, and unfortunately, they were really starving the business of capital. And so as we look back, we think about that era, and it reminds us today that the family really needs to be working for the company, not the company working for the family. If the family's taking more out of the business than they're putting in, the company can't be successful. Because of the lack of investment by the second generation of the family, the third generation really struggled. Louis Jr. took over the business, and after 2 years stepped down as president of the company. We brought in an outsider who was a flour salesman for General Mills, and his incentives were really misaligned with the shareholders. He was incentivized to go out and sell flour, not necessarily delivering margins. And through this era, the company survived, but again, didn't have the capital to reinvest in the business. In 1958, there was an outsider that approached the company about buying control, and the family later found out that the president of the company had actually signed over his shares in the form of proxy to the outsider that was going to buy the business. And so they offered to buy the company, and there was a lot of dialogue within the family. Do we sell, or do we try to make a go of this? The non-active family members basically stood up and said, let's cash out, this is a great price, let's move on. But the active family members in the business thought they could make a go of it. Unfortunately then, the buyer came back and said, well, let me make an increased offer to the non-active family members and see if I can buy this business. And after a lot of dialogue between Ethel, Louie's widow, and her youngest son, Don, they decided that they wanted to make a go of it. So Louie Jr. was no longer in the business. His younger brother, Robert, had drinking problems, was never part of the business, and so it fell to the youngest brother, Donald Mennel, to come in and run the operation. So at this point in time, Don came back into the family business. He had been out in California playing, as he put it, after World War II, and had worked in the business, understood the business, but hadn't been involved day to day recently. And first thing Donald had to do when he came into the business was he honored the price that the outside investor was going to make to the family. He took out 10-year bonds in order to buy out the inactive family members and paid them out over the next coming years as he was trying to rebuild a business that had been neglected and hadn't been reinvested in a number of years. He also then had to figure out how he was going to grow this business, and he went and studied family business at Harvard Business School and figured out what it was going to take to make this company successful, reinvest in it, and truly look at it as a perpetual evergreen business. He then later in his career started investing in other mills and wanted to grow the company. And in 1972, he made an offer on 2 different flour mills, both on the verge of bankruptcy. And he told his bank, don't worry, I probably won't get either one of these, but I'm going to make an offer on both of them. He then ended up with 2 flour mills, one in Dowagiac, Michigan, and one in Roanoke, Virginia. The company was stable at that point, but taking on 2 additional flour mills was going to put it in a very challenging position. Those of you that would have been around in that time may remember in 1972, 1973, something by the name of the Russian wheat deal occurred. And that's where the Russians came in and bought a large quantity of wheat in this country, and it drove wheat prices through the roof. Don found himself sitting across the desk from his bank at that point in time and said, look, I can make a go of this, but I need your support. And they said, you need to go out and find an additional bank because we can't continue to support the company in its position. So that was the first point in time when our family business took on outside capital. He had a board member that was willing to support the growth of the company and took capital in basically at a preferred stock methodology where it paid additional dividends to that board member and was able to really stabilize the business. That first step of going from 1 flour mill to 3 flour mills was really a critical step in our company's history. And Grandpa used this saying throughout his life that you take a tart when the tarts are being passed. He realized that in the flour milling industry that facilities would only become available maybe once in a generation or maybe once in 100 years. And sometimes you have to stretch in order to do what you want to do. And so he stretched at that point in time, had to bring in some outside capital in order to grow the business, bought 2 derelict flour mills, had to really reinvest in them and rebuild the workforce, but was successful in doing so. Then when he got to the end of his generation, he had to deal with buying out his uncle and his mother, who were the largest shareholders in the company. And when you're bringing along the next generation, you want to make sure that they're operating in the same manner in which you did. And so he took out 30-year bonds in order to buy out the previous generation of his family business, which certainly will make sure that his son didn't go out and spend frivolously because he had to pay off the debt of the growing family business. The 4th generation of the company was led by my father, Don Mennel. And my father really did a good job of professionalizing the business. In my grandpa's generation, the company really ran 5 days a week and the mill sat empty on the weekend. And Dad really believed in sweating the assets and built the staff and the workforce and the business to be able to run 7 days a week. And it really improved the performance of the business. At this time, we were only in flour milling and grain elevators, and he reinvested in both of those divisions and grew both of those divisions. He added a number of grain elevators around the country, and he built 2 greenfield flour mills in his generation, which was a major undertaking and were 2 of the only flour mills built in the previous 30 years at that point in time. He also focused on R&D, innovation, and reinvesting, and really becoming the best flour mill that we could be. And so we built the first R&D department in the milling industry and focused on wheat research and flour research. And we were extruding flour, we were heat treating flour, we were super drying flour. And he found an innovation in Europe where they were cooking flour. And he thought, well, that would be great, I'll bring it back and it can increase the stability of flour and would work really well in thickening soups and open up some new markets for us. What he didn't realize was there was a new innovation within the ice cream space. And in the 1990s, cookie dough ice cream caught the world by surprise. And we were the only mill in the country that had the ability to thermal process flour and have a kill step to take that raw natural ingredient and make it food safe. And so that innovation, it was accidental. We bought the equipment for another reason, but it really opened up a new market for us and a much higher margin market. And so we felt like we had really done everything that we could in flour milling and had perfected the trade. And Dad grew the business nicely, at the same time paid down that debt that he had taken on from his father's generation and did a wonderful job of delivering the balance sheet to me in a position where I could go out and reinvest in the company and grow the business. I represent the 5th generation of our family business, and at some point in time, 20 years from now, hopefully my picture will end up on a slide and people are saying good things about me, not bad things. But in our organization, you don't get your picture up on the wall until you successfully deliver the company to the next generation. So I stand here today at 46 years old. I've been with the company for 20 years. I have at least 20 years to go and hopefully can continue to reinvest and grow the business. I have a wonderful leadership team, and we've realized that to grow the business today, it's really going to be through M&A, because the cost of building a flour mill in rough numbers is about $70 million and about a 20-year return. So my father had the benefit of the economics, pre-COVID, where construction costs were at a level where he could go out and build new facilities and grow greenfield sites. With construction costs where they're at and construction materials where they're at today, we've realized that the opportunity for our generation is to go out and buy tired assets, spend some capital, reinvest in them, and bring them up to today's standards. Our organization's completed 7 acquisitions in the last 9 years. We're continuing to look for opportunities in the marketplace and really building a culture in our organization of growth through M&A. A quick snapshot of our company today. As I said, through my father's generation, it was kind of a 3-legged stool. We were in transportation, we were in grain, and we were in milling. And one of the opportunities that my generation's taken advantage of is investing in baking mixes. And the baking mix category is really underserved, and there's capacity for growth in that category. And everybody in here, I'm sure, when I say baking mixes, is thinking of those 10, 12-ounce boxes that sit on the grocery store shelves. That's not an opportunity that we're pursuing. It's a slow growth category and it's a low margin category. The baking mix category that we're pursuing is partnering with retail chains to provide their carbohydrate solutions, whether that's pancakes, biscuits, waffles, whatever those products look like. And I can confidently say that every one of you in this room have eaten our product in one way, shape, or form, whether you knew it or not. Today, we're approaching $1 billion in revenue. We have 885 employees at last count, and we operate in a 7-state footprint. We continue to reinvest and grow in our elevator and our flour milling division by adding capacity within our current facilities. And as I mentioned, we bought 2 baking mix facilities over the last couple of years. We're completely vertically integrated. We have our own truck fleet. We now have our own truck repair garages. And we've also made a investment within a large regional 3PL so that we can move some of our own products directly to consumers without paying outside warehousing costs. Our learning journey during the 5th generation of our company is how do we continue to move up the value chain? It's a tough business when you're selling flour as an ingredient to large bakeries, and they can compete. You're competing with 20 other companies across the country. It's a penny business, it's low margin, it's not sticky. They can move to another supplier tomorrow. Our opportunities in partnering with restaurant chains and developing their formulas and providing a product to them is much stickier, and you're building long-term relationships. The other challenge that I'm going to have to figure out how to overcome over the next 20 years is a 44-year generational gap. While most of my classmates are talking about taking their kids to college, we're working on potty training in my household. And so I'm going to look to my nieces and nephews and cousins' kids to figure out, how do we bridge that gap? But I have a feeling it's going to be a very long fifth generation within our family business. And really what I've been focused on the last number of years is building for perpetual growth. We reinvest most of the profits in our company, and so I need to figure out how do I best use those profits to deliver strong returns to our shareholders. We pay out about $10,000 a year in dividends. The rest of the money is reinvested back into the company. We've been a C Corp from the beginning. It was organized that way in 1886. And so when people talk about double taxes, I always bring up, well, you're really only paying double taxes if you're paying out dividends. The taxes on $10,000 is never going to break the company. So it's worked out well because it allows us to trim the family tree. My father's philosophy was, follow the Berkshire Hathaway model, reinvest in the company. And if inactive family members want to become wealthy off of their ownership in the company, they can do so by selling stock back to the company. We're not going to send enough money to the shareholders where they can clip coupons and continue to grow their wealth while just being passive investors. If they want to sell their stock, we always have a market for them. We're going to continue to grow the company and their wealth is going to continue to grow. But in order to perfect that, they have to sell the shares back to the company. It allows us to continue to trim the family tree. Today, our company is owned 86% by Mennel family members, 55% is my father's immediate family. So it's worked out well for us to continue to trim the family tree, and we're going to continue to do so. As I mentioned, our opportunities in today's market is through M&A, and so we've really been trying to become adept at corporate carve-outs. As I mentioned, we've made 7 acquisitions. 3 of those have been corporate carve-outs. Most of these are from large Fortune 500 companies where they have an asset that they've been ignoring, they haven't been reinvesting in, and there's an opportunity for us to go pick off that asset, reinvest in it, and run it the way it's supposed to be run. And I'm going to throw out a bad word here as far as Tugboat's concerned, but one of the ways we've done that is by partnering with private equity, using mezzanine finance. And I know those are not phrases that we typically talk about in this organization, but there's more and more money out there, and I think it's a way that we can continue to grow our organization. You'd ask, why would a company of our size deal with private equity? It's certainly not necessary, but I'm a firm believer in my grandfather's philosophy of you take a tart when the tarts are being passed. And it seems like in our industry, it's either feast or famine. We either don't see any opportunities for acquisitions or there's 3 or 4 of them that land in your lap all at once. And I truly believe that these milling assets and these mix facilities are only going to come up generationally. And so we either capitalize on that opportunity today or we pass it up for the next 30 years. And so by partnering with private equity, it allows us to make multiple acquisitions at one time while keeping dry powder. And I'll come to our board of directors and say, look, we've got these opportunities. They're both good opportunities. How do we capitalize on them? And they usually give me really good direction and say, Ford, this is core. This isn't quite core. Go find a partner if you want to do this one. We'll take some of the risk off the table, but you have permission to go acquire both assets if you truly believe in them. It also gives us a nice kind of honeymoon period with that new acquisition where we get a look at it and get exposure to it at a board level and an understanding of how that business operates. And if we have a PE partner and we decide that it's not a fit for our organization, it's very easy to spin that off and sell it out after 5 or 7 years versus our traditional model, which would be integrating it into our organization. The other nice thing is we're creating a pipeline of future acquisitions. The last PE deal that we did, we bought in 5 years ago and just completed the integration of it into our organization where we took out the PE folks. And it's a great learning opportunity for us. Private equity is looking at thousands of deals every year, where we're only looking at 3 or 4 deals every year. And I love learning from their expertise. How do they look at businesses? How do they evaluate businesses? And it's a good tool for us to continue to learn. I will warn you, not all private equity is equal, right? You need to look at where their money's coming from, where that in their deal cycle, Is this the first deal that they're doing in a fund, or is it the last deal that they're doing in a fund? The last thing you want is to be the last deal that they're doing in a fund. There will not be any follow-up financing, and they're gonna have to go to their LPs to try to raise money if you do want to continue to grow or reinvest within that organization. And at the end of the day, you're partnering with private equity because they've got the capital, but like any other business, it's a people business. You want to make sure that you're aligned on culture, you're aligned on ethics, and you're aligned on creativity, more importantly. Their model is typically to, squeeze the operation and try to grow top line so that they can sell it. But if it's a model where they know they have a buyer at the end of it, you can really design these to be functional and work well for both sides. Dave said, if you're going to talk about private equity, Ford, make sure you put a deal structure up here so everybody understands what we're talking about. Because everybody gets concerned when you start talking about partnering with private equity. So I'm going to be very clear. This would be a deal level transaction where we're going to go make an acquisition of a specific facility. We're not putting any Mennel equity at risk here. This would be to go buy a new flour mill somewhere. We'd have the ability to put $8 million into the deal without violating any covenants with our existing bank group. PE would put in $2.6 million as far as equity goes, and then provide $12 million of mezz financing to allow us to go reinvest in the asset. We would then partner with a bank for senior debt and our operating line of credit. This particular example was a milling business that was doing about $5 million EBITDA. It had been neglected. They hadn't been putting any capital in for a number of years. It needed updated, it needed reinvested in, but it was a niche business that had 2 large supply agreements with very well-known large national CPG brands. It just needed somebody to focus on the business. So this particular deal had 12% interest rate on the mezz financing and a 36-month lockout period, meaning that PE was gonna collect their 12% for at least 3 years. After that, we could take them out if we wanted to. And then the call and the put rights at 84 months where Mennel would have the right to call the PE equity, the PE group would have the right to put their equity. There was no opportunity for them to take out Mennel's equity. It was really designed for them to come in, generate some nice profits on the use of their cash, but ultimately it was gonna be a Mennel facility at the end of it, or that was the plan. Some of the lessons that we've learned from working with private equity: there's always more money out there than there are good deals. Stick to what you believe is right and the right structure for you. And if they don't partner with you, there's always somebody else out there. I've talked to enough of these PE groups and they are desperate to find good deals. And what would be a better deal than partnering with a 140-year-old company that's been dedicated to an industry for their entire history and knows the business inside and out? So we look at it as we're in a strong position, and it's a matter of finding the right private equity partner to work with. The second item is critical. Always negotiate the divorce prior to the wedding. It's a lot easier to do this up front than it is on the back end, and you really need to plan for multiple scenarios as to what that divorce is gonna look like. It's not as simple as saying, we'll buy you out on the same EBITDA multiple that we bought in at, because what if the company loses money? They're not gonna wanna sell it to you for less than what they invested in it. So it's really critical to develop that model in the beginning, and it's painful to do it later in the relationship. Again, if you're not gonna get a 12% ROI in the business, you can't very well borrow at 12% interest rate. So you need to believe in the model. It needs to be a sound business that you're gonna invest in. But if it's a good strategic fit for you, it builds a runway for you, it makes sense to utilize the model. Leverage does force discipline in a business, and it's a good thing, but you can't let it really impact the way you would operate the business. So allow it to force discipline, but don't cut corners in order to make it work to pay the note. The other trick that we've learned over time is make the PE group negotiate with the banks. We are our relationship bankers. We are gonna celebrate 50 years with our lead bank this year, and that's been a good long-term relationship for us. Private equity groups and banks that work with private equity groups typically get better deals than those of us that are long-term operators do. The banks know we have lots of assets that they can glom onto, where the private equity group only has the fund and there's not much else to support the deal after that. And so they typically can negotiate better terms, let them be the bad guys, and we can still maintain our philosophy of being a relationship banker. And so those are just some tricks that we've learned over time in partnering with private equity as we make investments, and I thought sharing that with this group may be beneficial. I also want to leave you with this. I stole the quote from Luca Delana in his book, Ergodicity, but in 1900, there were 13,188 flour mills in the US. Today, there's less than 200. Sometimes performance is subordinate to survival. The key is staying in the game, and the only way to win the game is if you're in it long term. If you make mistakes, you can overcome those mistakes. Just make sure that they're not critical mistakes. Thank you.